Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. I'm Jared Blikre, and today I am joined by Caleb Silver, he's the Investopedia CEO, and Brooke DiPalma as well. Thank you for joining us here today. Guys, our theme for today is retail, and guess what? It's kind of a loaded term because we are seeing an explosion in the meme trade right now. We got some big retail earnings on deck and also disappointing retail sales this week on Wednesday. So we'll talk about that. And our word of the day is diversification. It's more than just owning a bunch of stuff. We're going to break down what that stuff could be. And this episode is brought to you by the number 3.4 million. That's the calculated cost of the American dream, according to our guest and Investopedia. We're going to tell you why and how much by Americans are coming up short. Now, Caleb and Brooke, let's dive in. Want to talk to you about meme stocks here. It's been blowing up our Yahoo Finance trending tickers. I can only imagine the search terms you're getting on Investopedia. So what are you seeing right now?
Yeah, thanks to Roaring Kitty for coming back into the mix here. We needed him back to the party.
The excitement's here. The party's back.
He brought everybody back. So everybody's wondering who is Roaring Kitty again, in case they forgot what happened in 2021 or they haven't seen Dumb Money. I got a little piece in that movie myself. So there's that. There are people looking at short squeezes. What is shorting? What's a naked short? Don't naked short, folks. That is extremely dangerous. We got people looking for different ways that they can play this market right now as well. They're looking into trading halts. What does it mean when stocks are halted for trading? What is a circuit breaker at the exchange? Is there literally a circuit that somebody has to reset? No, but people want to know this because they forgot what happened a few years ago, or some of these people are experiencing this type of activity in the market for the first time, and it's exciting. We need this type of action.
Yeah, and let's talk about what's happening in the market right now briefly. We have the S&P 500, the NASDAQ at record highs. The Dow is very close right now. How are you seeing the market?
Yeah, are you not entertained? Stocks at record highs right now. We got meme stocks back in play right now. So the market seems like, it's okay, but we have this tale of two countries, right? Mm-hmm. You have the stock market at all-time highs. You have median home prices, right, at all-time highs. Asset owners, shareholders are doing great right now. The real feel of the economy, not so great. So that's what we're feeling on Investopedia. We have something we call the Investopedia Anxiety Index. This is our readers' search traffic to fear or anxiety-based terms. And as far as the markets go,
that's brilliant. By the way.
Yeah, thank you. They're not concerned because the market's at record highs. It's just been churning higher and higher, a little bit of a reversal in April, but they're not worried about that. They're not too worried about the macro environment, although inflation has been the dominant theme, and that's their number one concern. They're more concerned about their own personal finances. Mm-hmm. So you have people who are run up too much credit. They haven't been able to keep up with rising inflation. Maybe they got a raise, but it's just not keeping up. And then the things that we have to buy, insurance, food, rent, the things that you can't get away from, they can't get away from, and it's eating into their ability to invest. So we're seeing a little bit of a pullback just in terms of enthusiasm. We survey our readers every couple months, and right now I would say they are cautiously optimistic, but not necessarily promiscuous, not really getting into it. The meme stock craze may have woken them up a little bit, though.
I want to tap into that further because, like you said before, there are so many new investors who are just learning about this for the first time. Maybe they didn't even think about investing back in 2021. Now they're like, hey, I want to get into this. What are some key areas or key things that they should watch before they do jump into this market?
Yeah, see, they're going to want to get in, those that have been enticed by the meme stock madness, by the fact that...
Just jump in.
But I can get into this and take advantage and make a quick buck. We all know that is trading at best. Most of that is gambling. And if you're just getting in for the first time, you're going to get spit out by that we call catching falling knives.
Warning.
So that's not what you do. What you want to do, if you want to get in, you want to own a little piece of one of these stocks, that's fine. But build yourself a stable foundation of a portfolio with some index funds or some ETFs that represent the stock market, understand the way the market works, and understand how you're investing, know what you own. We always say that. Then if you want to do some things on the edge to understand how to research stocks and maybe trade them individually, that's fine. But if you haven't built the foundation, you don't have anything to build on.
Yeah. And what about retail stocks in particular? Home Depot announced earnings earlier this week. We have Walmart on deck. This is going to be Thursday morning, and we're going to be releasing around noon. But just in general, the trends that you're seeing in earnings season, and specifically with some of these retail stocks that are dropping now.
Yeah, so retail stocks have been sort of front and center in the question of whether or not consumers are tapped out, right?
Yeah.
We say, as far as inflation goes, which is cooling a little bit or growing at a much slower rate, that the cure for high prices is high high prices because eventually consumers tap out, right? They can't take it anymore. Well, they haven't proven that, but we have heard from McDonald's and now we've heard from Home Depot and others that they're trading down a little bit, right? Ticket purchases, the total costs are going down on average, so consumers are being a lot more sensitive about that. I'm the editor-in-chief of Investopedia. Thanks for the promotion earlier, by the way. I'll take the paycheck. But we are a part of the Dotdash Meredith family of websites, and that includes Real Simple, Better Homes and Gardens, Travel and Leisure, and Food and Wine. So we see the trends that consumers are thinking about across all these different categories. So no one's buying or selling a home. But what are we doing? We're redoing our mudrooms. We're redoing our kitchens. The little expenditures we're making, not the big ones, not the deck, not the roof, but the little things on the side. When people are shopping for food, we learn from Food and Wine, they're going down market a little bit. Maybe that middle section of the wine store instead of top shelf right now. So you kind of feel it across the portfolio.
Yeah, and what we learned in Home Depot's earnings was that people are pulling back on those large, big ticket redos, renovations, that
Durables.
DIY consumer really pulling back and perhaps looking for other ways just to stretch their dollar the best they can.
Yeah.
Well, I want to get to our word of the day. This ties in with what we're talking about. It is diversification. And typically about this time, I go to Investopedia and I read the definition, and there's no reason why this should be any different. So diversification is a risk management strategy that creates a mix of various investments within a portfolio. It should contain a mix of distinct asset types and investment vehicles in an attempt to limit exposure to any single asset or risk. Caleb, you have anything to add to this definition from Investopedia?
That is perfectly written and edited in.
You might have written yourself.
But I refer to it all the time too. And of course, it is one of the foundations, one of the bedrocks of building a real investment portfolio for the long term. We always say that. That said, if you look at the last 20 years, you could have really diversified by picking an index fund, picking an ETF, thrown a few darts at the dartboard, and been all right in a low interest rate environment, right? We've had an incredible secular bull market for a long time right now. Now there's big question about whether or not that's actually going to work going forward, or if you need active management to really get you that higher alpha that a lot of investors are seeking. We always think that diversification is core. No matter what you're doing, whether it's investing across a broad portfolio of stocks or different asset classes, or if you're just building wealth through different things like real estate, maybe owning a piece of a small business, having a stock portfolio, having some money in the bank, diversification writ large across everything you do, you can't go wrong.
Yeah, I would say a lot of people don't think of real estate, but that's an important part of the mix, and a lot of people have that exposure anyway. You also have commodities and volatility. You know, I know that you have an interest in gardening. I'm wondering if you can apply the mindset that you have in gardening, like maybe pruning your plants here to diversification and making sure that your portfolio has the right ingredients.
Yeah, we might call that tax loss or herb loss harvesting, but I do think about what I have outside of my containers going in this weekend, which is going to be a big, broad set of different culinary herbs. So you'll have your basil, right? You'll have your rosemary, you'll have your oregano, and when it comes time to make that Sunday gravy, I'll be using all of them. And,
I'm jealous. This sounds good.
Come on over. Dinner up at my place in Harlem this Sunday, Sunday gravy made with fresh herbs. That's diversification, right? So when you think about the way that we cook or the way, and I come from the restaurant industry, right? You want that mise en place, all the different things you need, well stocked, well ordered, in a good supply.
I love how you're running with this metaphor here.
Oh, I'll go all day long.
He's going all in.
All day long. I'll throw the apron on right now and whip up some guacamole. I don't care. So that's the way you want to think of it when you, in terms of building your portfolio or just building your foundational wealth. What different pieces work into that mix, all have different timings, all have different risk mitigation strategies. And as the CEO of your financial life, there's your CEO theme coming back, you want to make sure you're across all of those and manage them individually so collectively they work the best together.
Yeah, and there's so many asset classes that investors can jump into right now. And we hear a lot about the 60-40 portfolio. You want 60% stocks, 40% bonds. You know, when you think about commodities, when you think about real estate, when you think about cryptocurrencies, other asset classes, how should you sort of narrow these down in your head to say, hey, where do I even jump in?
Yeah, for white belts, start with an index fund, right? Start with some ETFs that represent the market. Understand that they can be sector specific if you want. But in general, index funds, just so you understand all the different stocks that go into, say, the S&P 500 or the Russell 2000. Build your foundation there. When you're getting a little bit better, talking about green belts here to blue belts here, then maybe it's time to mix in some tax mitigation assets here, maybe some munis work in your portfolio. As you get older like me, you're thinking a little bit less about putting the pedal to the metal in terms of risk. I don't know if bonds are the right answer there. We've been pretty much in a bear market for bonds, but I do have some bond exposure. You want to make sure that you are well positioned and well timed in terms of where you are in your life stages. But also, I do a lot of this work with my planner and my advisor. What's the best tax advantageous way for us to be investing now to make sure that we get the benefit of those gains 20 years from now when we actually need them?
Good points there. I'm wondering, we began this conversation talking about meme stocks, and another asset class is cryptocurrencies, which tend to be very streaky. And when we see Bitcoin at record highs, a number of things happen. That's when the Yahoo Finance trending ticker list just explodes with these guys. I actually only get recognized on the street when Bitcoin is at a record high. It's few and far between, but true story. Just wondering, we haven't talked about cryptocurrencies. Just wondering if you think there's a place for those in people's portfolios.
Yeah, I do. And I own some, and it's a very small percentage of my portfolio. It's less than 5%, and it probably always will be unless it explodes again, and then maybe I'll have to do some tax loss harvesting on my own. But why do I own it? Well, I do believe that 10 years from now, Bitcoin will still be around. I believe that Ethereum and the Ether token will still be around. There's a few tokens that I see that have real use cases right now, plus a lot of them are available to retail investors, as we know, through the spot Bitcoin
Easy
ETFs.
access.
So I want to own them so I understand them. It makes me become an educated investor. And when I own them, I understand how they move, when they move, and what they're tied to and what they're not. But I always make sure that it's just a small piece of my portfolio, along with other things that are on the higher risk end of things. In general, I'm a pretty boring investor. Why? Because I learned early on that I am not that smart when it comes to picking stocks. I will tell you this. I will actually ask you this. Name 5 of the best performing stocks of the past 30 years, and you'll probably get a couple of them right, but a couple of them would never have been in your playbook. Go for it.
Monster.
Amazon.
Amazon number 1.
Monster.
Monster number 2, but you wouldn't have picked it if you didn't know it, right? There's a couple other there on that list that just don't make any sense. So stock picking is not something I learned that I was very good at. So I went with the index funds and the ETFs, and finally, when I had enough assets and it got too confusing for me, I went with a financial advisor and planner because I don't know what I don't know, and I want a pro in charge.
Well, it sounds like a tailwind right there. All right, for our viewers on our live streaming platforms, we're going to take a quick volatility pause. For everybody else, we're going to carry on with the show. This episode is brought to you by the American Dream, and its cost anyway. So we're going to break this down. Investopedia has quantified the American Dream as costing $3.4 million. The problem is the median lifetime income for a person 25 to, I believe, 65 is 2.3 million. So pretty big gap there. Caleb, how did you arrive at these numbers? And just tell us about why you decided to go here.
Yeah, so the American Dream was actually our term of the year for 2023. We looked for the terms that had the most search volume and the most consistent search volume throughout the course of the year. We have 15 million people a month coming to our site. So though everybody's coming with an individual question, but when you look at it in aggregate, month after month, we saw that the American Dream kept popping up month after month. Now, it wasn't as big as, say, bank failure, because we didn't have because that only happened during a distinct period of time, right? That was April of last year. But this was something that kept coming up. And what we started to look at when we looked at some of the anecdotal data and the searches around it was not people saying, how do I get to it? It was this feeling that a lot of people feel that they're not going to be able to realize the American dream.
It's out of reach.
Live a better life than their parents. They work hard, they went to college, now they have debt, now they can't keep up with the cost of living. Maybe they'll never be able to afford that first home, so they feel like that's out of reach. So with our data journalism team, we went and we quantified reasonable expectations for what that dream would cost. And these are reasonable expectations. We're talking about things like paying for a wedding for a child over time, paying for a funeral, right? Buying 6 used cars over your lifetime. That's not crazy if you own a car for 10, 12 years, maybe having health insurance for your family, over 900 grand, sending a couple kids to college, just for a couple of years. Most people only do a couple of years of college. We put all this together, and it costs, in today's dollars, $3.4 million.
Staggering,
yeah,
actually.
Yeah, it's a big number. And when you think about the fact that, well, you can make that over your lifetime, the median income only gets you to about 2.3. So there's that gap of over $1 million between what it costs to have reasonable expectations to live and run a household, right? Raise a couple of kids and pay for these things, have a couple pets, and what you can actually make if you're just making the median income. And that gap has to be filled. How do we fill that gap? You have to fill
That's
it
the
within.
next question, right?
That's
Yeah.
investing, right? That's one of the ways to fill the gap. You have to make your money work for you, so it's not just you and your labor for the rest of your life that are trying to hit that number. And this number is different for you. It's different for me. It's different for everybody. We just took basics
My
based on what
American
everything
dream
costs.
is like 9 figures, so yeah.
Yeah, we're gonna have to ratchet this one up for you.
You know what? I really am curious though, when you think about this American dream and then you think about all the headwinds that are up against the everyday American right now, inflation, higher rental costs, higher auto costs. How do you possibly recognize that in your head or reconcile all of it to say, I can still pay for my kids to go to college while still affording that weekly grocery trip?
Yeah, that's why you see that dissatisfaction. You see it in the consumer sentiment numbers, right?
Yeah.
You see it in the consumer expectation numbers for what inflation is going to be. You see it in the Gallup polls, right? Why do people feel like even though GDP is actually all right now, the stock market's at a record high, asset prices have risen, you can get 5% in the bank, people just have this dissatisfaction because they don't feel like they can ever get on top of it. Now, some of that is because we spend too much money, right? People always say, I'm living paycheck to paycheck. Well, what are you spending your
What are
paycheck
you
on?
doing? Are you traveling? Are you eating out?
What are you spending your paycheck on, and what does it cost to be you? A lot of people never determine that. That is really the core, the essence of financial planning. What does it cost to be you today? What is it going to cost to be the you want to be in the future? And a lot of people never really do that. They just start spending and keeping up with the Joneses or getting the new truck or taking the
So
vacation.
hard to get swept into that, though.
It's hard, but we work hard in this
Yeah.
country. We're a hard-working a bunch of Americans who want to take a vacation, who
Yeah.
want to have nice experiences. The thing is this: if you are not putting money away and paying yourself in the future and allowing that money to compound and grow over time, you're never going to be able to afford your time, and you're always going to feel like you're behind it and never going to get to that dream, whatever that dream is.
You mentioned a key word here, compounding, and that could easily be one of the words of the day. It's a very powerful concept that Warren Buffett likes to talk about, and it's simply that if you do things on a regular, periodic basis, those things, they multiply over time and they build on themselves. What does that mean to you? I know it's a little bit glib to say, just let your money work for you, but what does that actually mean to you?
Yeah, it's the ninth wonder of the world. That's what Einstein called it, for a reason, right? This is the fairy dust that is sprinkled over investing, and this is allowing your money, when you look at things like the rule of 72, how long it takes for your money to double at a certain interest rate. But this is very real, and it's hard to realize this, and I didn't realize this when I was a younger investor because you don't feel it when you're dealing with small amounts. But then it's like everything all at once. After about 15, 20 years, when the numbers start to get bigger, and then you have a couple of big years in the stock market or 3 big years in the stock market like we had post-pandemic, then you're like, well, wow, what just happened inside my portfolio? I didn't do anything. No, you didn't. Yes, you did. You did it 10 years ago when you started investing on a regular basis and adding to it and letting that money work for you. I love this analogy. It's a metaphor that I learned from Vivian too, who says you have 2 pools right now. There is your labor pool, the money you make and you get in your paycheck every 2 weeks or every month whenever you get paid. That's to sustain you. And then you have this other pool of money that's working. And that's that 10% you're kicking over to yourself. You got to get that working too. And one day you're going to slow down your labor, but your money is already going to be working in the background for you, and that's the money you're going to live on. A lot of people don't realize that's how it
beautifully
actually
put.
works.
Yeah, I like that a lot.
Look, I've been doing this a long time. When she put it that way a couple months ago, I was like, perfect. You got to have this pile working over here because you're going to eventually want to stop working. That's how that works.
Yeah, and what I do want to follow up and ask on that is for investors who didn't come from families who think like this, how do you alter that mindset and convince your spouse, convince your siblings, your parents even maybe to get in?
Yeah, well, I didn't come from a family that thought like this, right? I came from a family that didn't make a lot of good financial decisions, and I'm not saying that, we were bereft or anything like that, but we went from having nothing to having a lot to having nothing again, and then scratching our heads wondering, how did that happen? So I had to figure it out for myself, and that's probably why I do what I do today. So financial trauma, your financial history shapes you in a lot of ways. But when you just look at the math, right? I do this a lot with high school kids and even with ninth graders and eighth graders. We just look at that rule of 72, right? What happens if you put $100 in the stock market every year for 10 years? What about 20? What if you add another 100 to that every year? What does that then look like? And the basics is this. If you start investing when you're 25 at an average of $6,000 a month, and nobody at 25 has $6,000, but by the time you're 36, you might, and we're talking about a Roth IRA contribution here, a little bit less. If you do that every year until you're 65, you're going to have $750,000, right? $6,000 a month on average. If you start at 35 years old, you're going to have $450,000. Not too shabby, but there's $250,000 that was just there because you started earlier. So we always say at Investopedia, the best day to start investing was yesterday. The next best day is today.
It is now time for our Hollywood segment, Who Wore It Better? And Caleb, you are a documentary filmmaker, so I'm especially glad to have you in the house here. I'd like you to focus your powers of awareness around this very common investing dialectic that we've been talking about, which is passive versus active investing. Passive versus active. And since the theme of our show is retail in the U.S., I'm going to ask you, what investment style are retail investors owning or wearing the best? Is it active investing or passive investing?
Well, passive investing is something you can wear for all seasons. So I would say for most retail investors, and most of us do this anyway, if we have a 401k or an IRA or a Roth IRA, we decide where we're going to put it, whether that's a target date fund or a bunch of different mutual funds or index funds or ETFs, and we just do it every couple of weeks. As I said earlier, we survey our readers every 2 months about how they're feeling. Right? What's the vibe? And most of them, and we always ask them, what are your top 10 stocks? And what stocks would you buy now and hold for the next 10 years just to see where their sentiment is? They don't change a lot. It looks a lot like the top 10 stocks in the S&P 500. The herd follows the herd. And the herd has been right, more or less, for the last 60 to 70 years. So passive investing is something you can wear for all seasons. If you are the type of person that can spend the time to learn what you're doing and trade your account when necessary, but do it in a tax-efficient way and pay attention to different things like patterns and put some stop orders in and some limit orders in to make sure you don't get burned, have real risk management techniques in place and rules-based investing, then active investing is great. It's fun. That's how we learn. You can learn for the rest of your life as an investor. Most people don't do that and don't want to pay attention to it. And they think they can do it and they stop paying attention for a second. That's when the losses start. That's when they get burned. And that's when they jump out of the market.
You know, how has your past informed what you're doing at Investopedia here, whether it's your gardening, whether it's your filmmaking efforts, anything like that?
Yeah, I sound like a Martha Stewart here.
Not a bad thing.
I love it. You love Martha. Look, I started my career in the restaurant business, right? Because there was a lot of financial trauma in my
Management
family.
chef.
Busboy, cook, prep cook, line cook, guac maker, waiter, manager. I did it all, right? Because there was some financial trauma and I didn't want to leave my financial future in somebody else's hands. I didn't feel like I could trust anybody with that. So I started working very young, probably too young for labor laws, but back in the 80s, anything was possible, especially in New Mexico, where I'm from. So I did that, and I started earning my own capital, right? So that I could do the things that I wanted to do, have some money in savings, start investing early when I wanted to, bought myself a television camera when I got out of college, taught myself to shoot, Betacam. Yeah. If you're some of you who are old enough might remember that. And then became a documentary filmmaker and a news stringer and a photojournalist, even did some work here for Yahoo back in the day, so that I could earn my own capital, right? All of these things taught me, A, how to run a small business, B, the power of earning your money through labor and what that does, and then the power of saving and investing over time. So with all of those things, from my days as a cook making guacamole in Santa Fe, New Mexico, to my days as a documentary filmmaker chasing illegal logging activity through southern Brazil, to what I've done at Bloomberg and CNN, the through line is I love storytelling. Right? I like working with teams, right? I like looking at how businesses actually work, you know, what makes them tick, and putting all those things together and being able to be sort of the explainer-in-chief, including the editor-in-chief at Investopedia, one of the greatest gifts of all time. I think I have a really cool job, but I had to learn those things myself to become the person that I am today, and I'm really grateful for it.
And we love those explanations over at Investopedia, and really thank you for your time here and coming today. We got to wind things down here at Stocks in Translation, but keep your dial tuned to Yahoo Finance.